closing, maybe temporarily, but it's not. We've looked at every company that has gone public this week, and they've either priced below the range or at the bottom end of the range. So that's a sign that the supply of new shares, newly issued shares through IPOs, is getting a little big, which means that these companies are going to have to start pricing at the low end of the range if they want to get the deal done, because too much supply, you need to price it cheaply in order to encourage investors to really buy into these shares from the get-go.
Max, is what we've seen today indicative of something more endemic in the broader markets, or is this really about the individual stocks? Because Weibo is a very unique story.
Yeah, so I think Weibo kind of had a big tailwind where they should have had a headwind where they should have had a tailwind here. I think being a risky asset like all new IPOs are, being a Chinese domiciled firm and a China story, and being a tech story was a kind of perfect negative storm for what is a very compelling, very good offering. And I think it's important to see that even if they priced at 17 in a $17 to $19 range, they're right back up to the top of that range today with a slightly smaller offering. I think that's really does speak to Leslie's excellent point that there is a limited demand here, so I don't think you want to overshoot the number of shares you drop on the market.
And quickly, Leslie, I know you were listening into my interview with Charles Chow. What stood out to you of what he said?
I thought he was very candid. He acknowledged the market difficulties. He acknowledged that their timing maybe wasn't perfect. You look at their U.S. counterpart Twitter, and all the stars aligned for them, right? And Charles Chow was very open in saying, yeah, the market kind of sold off, but we got the deal done. We're here. We're a publicly traded company, and, you know, we're looking forward to being one moving forward.